name is Patrick O'Connell. I run O'Connell Advisory Group, OAG Transaction Services. A lot of you have joined on some of my prior webinars. Today is a unique episode. I'm joined with Ryan over at ExitWise. He is a valuation expert. I had the pleasure of meeting the folks over at ExitWise earlier this year, and I'm really excited to have Ryan join me today. Ryan, I'll give you the floor to introduce yourself and meet everyone.
Yeah, thank you, Patrick. Happy to be here. And like you said, thank you everyone who's given up a lunch hour or other to be here. I'm Ryan Clark, managing partner at ExitWise. I run and oversee our valuation practice. I've spent, the better part of the last decade, over in, from accounting to finance to M&A advisory, and really helping to advise companies in lower middle market on not just valuation, but how to position themselves, to go to market. So the conversation today, kind of that first 20 minutes, I love this topic because a lot of it is, how do you just to take a step back, what got me like in undergrad into accounting in the first place, despite how unsexy that field um, is the story that is told through numbers. You can look at spreadsheets and all that and really come up with a really good story of a business. It's a lot different though when you're a founder and you're placed in front of a buyer for the first time, and you're having a conversation about who you are, what your business does, the real world problems that it solves, and why it's valuable. And I think when you can find a marriage between kind of that pre-buyer conversation in terms of what is your story that you tell versus what is the story that your numbers tell, and when you can make a cohesive story between the two, it really goes a long way in the entire process of that M&A journey. Which for most people, if you're fortunate enough to be in that position, it's going to be one of the most financially rewarding things you go through, but it's also going to be one of the most emotionally demanding things that you go through. So that pre-go-to-market prep, all of these things that we're going to talk about today are super important, and they really set the groundwork for your M&A journey that you're about to go through.
Yeah, I think that's a great point. And a lot of what's overlooked in these transactions is the non-quantitative values, the stories behind these businesses, these great small businesses. So I love that we already kind of brought that up. So, who does this apply to? And without being too broad, really, this applies to those business owners who are, have these legacy businesses thinking about selling. Maybe they've spoken with brokers, gone to market, weren't able to find the right fit. Entrepreneurs, aspiring business acquirers, so folks, in the ETA space, independent sponsors looking for these small businesses or these privately held companies. And lastly, there's a growing pool of investors, so limited investors, people who are looking to deploy capital elsewhere outside of traditional private equity funds. This is a newer trend, which I'm seeing a lot in the market of um, wealthy individuals investing in these small businesses in a limited role. So putting together this $1 million impression, in the first 20 minutes is something Ryan and I kind of spoke on earlier this year. And I think any kind of impression, especially when it applies to small businesses, is super valuable. So we can kind of just jump right into it. Ryan, if you want to just kick things off with this.
Yeah, so I think one of the things that you and I know we at ExitWise do this. Typically when we take a company to market, we usually start with a valuation, and this isn't a Q of E level valuation. This is we're going through the normal. We're doing a DCF, a 5-year projection, market comps, precedents, trying to triangulate some level of value. And in order to, go to market and effectively get that value, or to get what the market is typically going to value you at, it requires, obviously strong financials, all of those things, but it also requires a lot of prep ahead of time in terms of, what is the story that you're going to tell? how cohesive is that story across all of the marketing materials you put together versus your website versus the story that you personally as the founder are telling. So I really wanted to kind of focus there, kind of to just to get us started, was those immediate valuation cues that a buyer is going to rely on. And in the lower middle market, I think one of the first things that buyers are typically looking to answer is, am I buying a business or, am I buying a job? And again, you can answer that in a multitude of ways, and sometimes you're answering it indirectly in these conversations, just based on how you position the company, how you tell the story. But ultimately, is there a lot of founder dependence, versus is the business able to run independent or without you? And I think that one, I mean, we know from a modeling perspective, if I'm a buyer and I know that this business can't run without you, but I know part of your transition plan is not to stay with the business long term. I need to model in, some additional costs to replace you, or maybe you're under market, currently, in terms of your own comp. But a lot of it is figuring out, okay, where is the buyer or where is the seller at in this process? What are their intentions post transition? Or do they want to stay with the business? And is this a business that can be run with or without them? If you disappear for 90 days, what happens to the business? Does it not miss a beat, or do things just completely fall apart? And a lot of that has to be ironed out throughout these conversations, especially in transition plans and documents and everything that get put together, to figure out what that looks like. So long-winded way of basically saying, like, if you're a founder and the business is completely dependent on you, there's not necessarily something wrong with that, depending on how you envision a transition or a structure being put together or a handoff between buyer and seller occurring. But it's something you want to have kind of top of mind when you go to market, because you can't expect somebody to step in and take over the business under the same kind of outlook that you have without you as the founder there anymore. Um, anything you want to kind of add to that in terms of founder dependence versus business independence?
No, I love it. And it's a great quote you pulled from Bezos, where it's your brand is what people say about you when you're not in the room. It's really, I love how you highlight the repeatable processes versus heroics. What buyers, and I've worked with hundreds of buyers, are looking for these businesses. So if you're looking to sell your business, step into the minds of the buyer, because ultimately you need one party or one buyer to get on board with your story. They're looking for repeatable processes versus the heroic seller. And you could probably agree with that.
Yeah,
While the business probably started with, a heroic seller or owner to get them where they are, the fear is when they are no longer with the company, their attributes are gone. Like, can the business sustain itself? So, a lot of the people I work with, and when I'm looking at companies, the question is there a repeatable process? Is there a management layer? Those are a lot of the things that are driving value, at least what I see.
100%. And then that's something that we see right across the board. Doesn't matter the industry. It's people, process, and technology. And if you have those three things in place, you're going to command typically a higher multiple. If they're quality, and you can articulate that and show that and prove that, that you have those three things. I mean, it's a winning formula, no matter what industry you're in, where you're coming from. And you got to just remember, as the founder, when the people part of that, again, depending on how you envision your role in this company post acquisition, is typically not a long-term part of that people equation. So do you have, to your point, the management layer and all of that in place is super important. Um, uh, you know, I think we kind of covered, whether the company can operate without the founder, and that really goes hand in hand with founder dependence. Um, Clarity on the core value proposition. This is, I think at the end we may do a summary on kind of the key takeaways. I think clarity comes first, in terms of a prepared seller. Can you articulate, in that first 20 minutes, what your company does, why it's valuable, um, while, kind of being able to, without saying it, articulate that there is, there's durability here, there's scalability, there's transferability. It's those things that matter. Can you articulate that while explaining what your company does, how it does it? And you're not giving away, in these first 20-minute conversations, you're not giving away your secret sauce or anything proprietary. And if you can articulate why your company is valuable, durable, transferable, et cetera, you're usually gonna, look really good, in the buyer's eyes in those first 20 minutes. Because really, this all comes down to risk assessment, right? It's $1 million first impression, and you might start at $1 million. A buyer might give you that benefit of the doubt, and it's really from there where you're kind of working yourself up or down from that $1 million mark, as you explain the story. And if you can do it with clarity, with precision, and be articulate, and a lot of that comes from, I think, two things. One, it's being well prepared, and a lot of that comes ahead of time. And second, and I believe I did a LinkedIn post about this, Patrick, this is right in your wheelhouse. I don't think that there's anything that prepares a seller better for going to market than a QofE. And that's it's this whole separate conversation, but doing things like that, being that level of prepared when you go to market, will lend itself very well to not just clarity, but a lot of the other things that we're gonna touch on throughout the conversation.
Yeah, and I tend to agree. Certainly, I think it's more of engaging professionals early in the process. If you want to conduct a sell side QofE, what that gives you leverage into is learning how buyers will frame questions. While, I try to break it down into simple terms. There is a learning curve of how people will speak and like the line of questioning prospective buyers will ask. And you may have a great company, but if you're not comfortable or ready for that line of questioning, you may portray yourself as unorganized or inexperienced when in reality, your business may be very organized. So it's almost like, we all took the SATs. We did a prep course to learn the language of the test. This is really what that preparation for. It's learning the answers to the test.
Absolutely.
You have this great business. Let's let's get the cheat sheet and maximize your sale.
Yeah, I love the analogy. It's like going into that SAT with the cheat sheet, right? Because you've done the homework, you know exactly what to expect, you know what's going to be on that test, and then when you get in there, you can take it with some confidence, and confidence usually exudes clarity because they really go hand in hand. I had a college professor who one time we go in there and it's like this big finance end of year exam, and he says, raise your hand if you're nervous. And probably like 80% of the class raises their hand. And he's like, you guys know that nervousness is just a symptom of the unprepared. That quote always stuck with me because it goes hand in hand with so many things that you do in life, and selling a business is certainly one of those. If you go into that initial buyer conversation, you're nervous, palms are a little sweaty, whatever. It's usually because you just don't feel quite as prepared as you should be. Um, and the more you can do ahead of time, the better.
Yeah, I certainly agree. For those of you with us as we go through these slides, if you want to throw your questions into the chat, Ryan and I will kind of tackle them one at a time. If you have any questions or clarifiers, feel free to pause and we can kind of take a step back and answer a couple questions. So, what are some signals without spreadsheets? I love this slide. I'd love to dig in more on this.
Yeah, I think it's in those, again, we're going to keep this in kind of the frameworks of that first 20 minutes. So we're going to assume that, the person on the other end, maybe they've seen a teaser, they've got some high level financials, maybe they know your revenue, maybe they know your margin, EBITDA or otherwise, but they don't know a lot of the details. Um, And so in those first, couple post NDA initial conversations that you're going to have with a buyer, they might, some might poke a little bit in terms of just trying to understand how well you understand your business. And a lot of the reason that they do that is because they want to understand, what are you tracking, what are you measuring, what are you working towards? How close are you to your numbers? So it's not just about, understanding your margins, but what drives them, not just, hey, I know we're at 20%, but how do you get to 20%? Is it a function of labor mix, or pricing, or utilization? Do you do a lot of discounting in your line of business? And then, if I'm a buyer, understand most buyers come in because they see opportunities to scale. What happens to margins as I scale this business? Right? It goes back to kind of that whole, is there good transferability? Is there good scalability within this business? Because as a buyer, hopefully as an advisor, we have kind of weeded out buyers who fit your thesis. But typically the thesis is to grow, right? They see opportunity, and they want to know that you understand what those drivers are, not just for the sake of you knowing them, but because they want to know that typically if you know them, that means you're tracking them. And that means that things are usually a little bit better run than kind of just 20%, 30%. Okay, well, that's a big range. Help me break down why there's these fluctuations, or what really is driving ultimately your margins. Um, you know, if you have seasonality or revenue volatility within your numbers, why? Is it simply a timing thing? Are you on a cash basis and it's just based on annual contracts, or typically renewed on a certain date? Is it customer behavior? Is it the way that you internally execute things? Maybe your back office is lacking. You're not always kind of up on invoicing, but understanding, any revenue volatility or things like that in a logical and, again, clear, concise way, really goes a long way with a buyer. And again, sometimes this is too early of a point to make with a buyer, but it could be one that matters if you have annual fluctuations in your revenue. So if I gave you a teaser and I've got 3 years of historical revenue, and they kind of ebb and flow a little bit, what is causing those ebbs and flows? And again, if it's purely a timing issue, or you just lack a sophisticated back office, you can talk through those things. But if it's customer behavior, or economic headwinds, or something, it's good to know those, and at least have some high level explanation to address those without causing, panic or concern, or in the buyer's mind, some sort of like immediate discounting that they're mentally doing as they're having the conversation.
Yeah.
Anything you want to add there?
Yeah, I love it. So what do you say to sellers that maybe, newer to the process, they've honed in on their 20 minutes and now they're starting to get tripped up with the questions about the metrics and the numbers? What's some coaching you do around that?
Um, Typically what we say is we'll give them advice kind of pre-call, pre-intro to the buyer, and we let them know, like, hey, here's some off limits questions, because you might get pressed too hard initially by a specific buyer. I think a lot of buyers who are a little bit more seasoned will come in a little bit defensive in some of these lower middle market deals, where they feel that, okay, maybe the buyer or maybe the seller is just trying to sniff out a multiple. Maybe they don't really have intentions of going to market. They're just trying to figure out where the market is valuing them so that they can decide their next move. So they might come in and press a little bit. We'll usually coach on, here's 20 questions that we feel comfortable answering. And typically you can point to, we've already explained these surface level in a teaser, in a sim. You could disseminate this stuff just from going to your website. So these things are fine, right? You can cover these things and touch on them. Again, making sure that you're consistent with any information a buyer might already have. But hey, if they start asking, very, very specific or nuanced questions, maybe you feel like you're, better off kind of holding on that answer. Typically we'll coach them on what to say, but it usually comes out in some form of, we have that information available. We would like to maybe disclose that in a second round of conversations, but happy to do so, depending on how this conversation, continues to go. Um, And that's usually kind of how it comes out, but it's more of, we're usually talking to these buyers before they get in front of our clients, and kind of giving them expectations on kind of what to expect, the level of questioning or the line of questioning that they have, and trying to suss some of that out to give the seller a little bit of a head start, almost like that cheat sheet you're referring to, like, hey, our cheat sheet might be very broad, but in this specific buyer, he's really looking for these things, and if he can get answers to these things and feel comfortable around them, then he's going to be happy to kind of move to a second, third, fourth conversation, as you hopefully look to get to IOIs and LOIs, et cetera. Um, but yeah, we typically just tell, sellers, don't be afraid not to answer a question. Just be friendly about it, explain, our positioning in that conversation, et cetera. Is there anything specific that when you're coaching somebody and maybe they get asked something, and whether they're getting tripped up on it or maybe it's something they should have answered in the first place, that you kind of tell them?
Yeah, it's a great question. And I love speaking with folks like people at ExitWise who represent primarily sellers because I primarily represent buyers. So I see in their lens a lot. And things that we get tripped up over is when there is lack of clarity or there's confusion in the dialogue around certain questions. Um, and the buyers may be guilty of this, or the sellers may be they may be trying to give answers as they come in, but if they begin to shift the narrative around the questions, that's when confusion strikes. So if we ask about a certain customer or like a business process, if we're given two different answers, that's when the story starts to leak. So I actually do like that coaching advice of rather than answering the questions fluidly as they come in, taking the time and being thoughtful and then providing those clean, simple answers consistently probably is helpful to buyers because a lot of times I have discussions with buyers, whether it's strategics or individual buyers, and they'll bring me problems of confusion. Hey, they said this, and when we sign the LOI, now it sounds like it's this. And we spend days and days just trying to figure out like, well, are they lying? Is this intentional? Most of the time, it's not intentional. It's just
Exactly.
um, so I like that. I like that perspective, and I think it's valuable because again, confusion kills deals. A lot of times I see, and it can be easily avoided. What are some when you're thinking about the comfort and discussing cash flow versus EBITDA differences, what does that look like in practice?
Yeah, I think, typically it's CapEx. So when we are providing a teaser or kind of a preliminary financial workbook post NDA with buyers, before they've had conversations with the seller, we do, I feel like we do a really good job of setting them up with a financial workbook that doesn't give away too much, but it does, consolidate a view of an income statement, a balance sheet, a cash flow. And then we have, a little dashboard on there that's going to say, hey, here's the cash flow statement in terms of kind of your three buckets over time, over the years. And if they see where cash is really deviating from EBITDA, because again, EBITDA, not being a gap term, right? Most people are using it as a proxy for cash flow. And if the cash flows aren't always matching EBITDA, you're really just trying to figure out why. And maybe it's a CapEx, heavy business, because a lot of times, like I've represented companies where we will state that we'll define, free cash flow basically as, EBITDA less CapEx. And a lot of times those things are going to be foreign to a seller in the lower middle market who's trying to wrap their head around, going from turning all of their numbers in at the year end for tax prep, to organized financials that are buyer ready, that they then need to speak to, because it's not what they're used to maybe speaking to when they have these normalized versions of EBITDA, and we adjusted for a handful of things. Um, And usually those fluctuations, again, they simply just come down to some sort of capex or the role of accounts receivable or inventory or something like that. And typically, what we're trying to coach sellers on in these initial conversations, um, because sometimes you do get asked things around that because we have prepped buyers with that information. Um, I would say, 9 times out of 10, I'm on that call and I'm kind of jumping in and fielding that question because it's a little bit more technical. But what you want to coach the seller on in these instances is the model that you built and the assumptions that are in there, and you want them to own those models. And if you don't help them understand what's in them, it's hard for them to take ownership of them and then to be on the same page. So a buyer might need help understanding these different fluctuations, and maybe you have an AR issue again, because like I said before, you're not always going to have a sophisticated back office or an invoicing mechanism or dunning letters that automatically go out to your overdue clients every week. And some clients are just can be difficult to collect from depending on the industry and contract terms and all those things. So it's more about just getting the seller very comfortable with, again, very high level assumptions that are used in their own financial models before you go into these conversations in case they get asked. Because again, although I'm going to jump in, 9 times out of 10, sometimes you get sellers and they are just on a roll, right? They just went through their whole, value proposition, why their company is great, why anybody would be, out of their mind not to buy them at the highest possible multiple that's out there. And then they get a question, they're like, oh, let me take this one. And they just keep going. So it's about kind of getting ahead of that and just making sure everybody's on the same page, not just in terms of, the story that they have to tell verbally, but making sure that the story that a buyer has already seen through the numbers matches what they're saying and helps the buyer make some rational relationship between EBITDA, cash flow, AR, deferred revenue, capex, all of these things. It just helps them gain comfortability. And when you can coach the seller around the assumptions that you've made, and the seller does chime in that conversation, and it just reiterates what you've said through the financials, it usually creates a very positive outcome coming out of that initial conversation.
Yeah, and there's a lot of great nuggets. One buyer tip, and I use this all the time because it works, is I always advise them to get the sellers talking. Just start asking simple questions about the business, and once you get them on a roll, they will just go on for hours on end.
Yep.
Uh, how you get them to that point is a little bit different depending on the person, but once you do, you could have a 5 hour call with them because they're
Yep.
just going to go on a roll. And for better or for worse, you'll get a lot of information out of them quickly. So that's a technique I use a lot. Again, I represent a lot of buyers, and the buyers are really ultimately looking for just the story around the numbers, especially for these legacy companies. There's just so much to unpack in and learn about the company before you make that decision. It just takes a tremendous effort to unpack 20 years of history in a matter of 3 months or 5
Absolutely.
months. So it sets a different set of circumstances, and ultimately we all kind of have the same goal.
Yeah. And if you're the seller, and you're going to be super passionate, to your point, if you spent the last 10, 20, 30 years, or this is a multi-generational company, that you're now taking to market. I mean, there is so much passion, in that. And to have those conversations, sometimes are very exciting, and very emotionally driven for sellers. Um, which raises a whole nother point of kind of the psychology behind a buyer and a seller, the emotional factors that are in there. And we always try to coach our founders on trying to remove some of the emotional aspect just to keep the conversation on rails a little bit. Make sure it doesn't go sideways, you're not divulging too much. But I don't know if there's anything I love more about this job than just seeing people who are just super passionate about what they've built, because those ultimately are the people that you get the most satisfaction out of helping.
Yeah, and as a business owner, I'm super passionate about what we do. Helping buyers with QofEs to analyze these businesses and sellers to maximize their exits. So when I see that fire, I can relate to it personally.
Yep,
And I got into small business acquisitions as an entrepreneur. So at the end of the day, I do resonate with them. And when you can see the fire, I mean, those are the best types of deals to work on, where
absolutely.
there's some passion, etc. But yeah, I digress. So let's see what we got next. The signals without spreadsheets, we kind of just touched upon that. Let's see what we got next. There we go. So um, automatic multiple compression triggers. Let's touch on that.
Yeah, I think a lot of what gets assessed isn't always directly being said. And that's very much true in the I am the business mentality. I've never been on a call with a founder or seller who comes into these conversations and stresses that they are the business. One, because we coach them that that's obviously not what you want to do. But there are things that are said throughout conversations that make you that would make a buyer believe that maybe this business is not a business without you. And if I'm a buyer, that introduces a lot of risk. So that's going to, in my mind, compress whatever multiple I'm starting at, to some degree. And it doesn't mean you can't work back up from there based on the conversation that you're having and where those conversations go and the financials that you show. And maybe you have a roadmap in place that's already been started that solves for that, but it's typically something that is the very one of the very first things that a buyer reads from a seller is. And again, I think it goes back to the very first bullet point we talked about, right? Is it, am I buying a business or am I buying a job? And most buyers aren't coming in to buy a job, they're coming in to buy a business. So if you're articulating what the business does and you're like, look, every contract that comes in, I'm signing on, I'm getting on calls with every client that we have, I'm the face of the business. We have mostly grown this business through no marketing spend, which means if you the buyer come in and you pour a bunch of gas on the fire, this thing's going to take off. And then the buyer responds with, well, how have you gotten to where you are today? And you say, oh, well, it's my network. Again, those are basically indirect ways of saying I am the business. And it becomes, it becomes tough when you're the buyer to put a higher multiple on that. Um, I think, if you're telling the story again in those first 20 minutes, I'm a buyer. I probably have already looked at, a teaser, a sim. I've gone to your website. Maybe I've asked ChatGPT to tell me everything it knows about your business. Um, and all that comes back and it creates a story in my head that I already have as a buyer going into this conversation. And then when your first 20 minutes are spent, maybe not contradicting, but being inconsistent to everything I've already learned about your business, it's tough for a lot of buyers to reconcile that, especially when most buyers, as a seller, it's you're selling one company. As a buyer, you're probably interviewing dozens of them, right? So if you find these immediate triggers where there's too many inconsistencies, it doesn't seem like there's a real brand presence here. The seller, over the first 20 minutes hasn't clearly articulated who they are, what they do, why they're valuable. It's all of those things that really create a lot of apprehension in the buyer and quickly allow them to step back and either back out totally or just start compressing multiples in their mind because they know that there's going to be a lot of investment that needs to be made to get this business to where it should be. And again, you're not, as a seller, typically saying those things, right? Or you don't know that you're saying them. But you have to understand, what are all of the things that this buyer is coming in already armed with? What information do they already have about my business? And how can I reinforce that and reinstill this level of confidence and do everything I can as a seller uh, to mitigate or not introduce risk into this deal?
Yeah, and I love a lot of these bullet points. A couple that trigger in my head is when we have the idea of financials that appear assembled, not managed. What I see in practice on a few deals, even last year, is assembled financials don't tie out to anything. They don't tie out to the tax returns. They don't tie out to the SIM, or if the SIM is assembled and it doesn't tie back to the financials, it kind of and this is a good point for sellers. It goes back to the point of like clarity. Like it begins to look poorly as buyers who, you know, they're looking at many companies. They may love your company, but they're not married to it. Like
Right.
if there's inconsistencies and the financials look assembled, the buyers, especially if they've done acquisitions before, they already know this one's going to be a challenge. So, like, what do you tell sellers? Because given you know some of those assembled financials look poorly, like, how are you coaching them? Like, what does that look like?
Yeah, typically what we do, and you get these in different flavors because you have sellers, founders who come to you, and they've already given information to sellers, right? They're like, oh yeah, he contacted me, sent me an email. He's been doing it for the last 3 months. I finally decided, hey, what the heck? Um, he asked for, some financials. He seems like a sophisticated buyer, and I had my accountant send him my last 3 years P&L. That's always like a oh no moment for us, because then you can't control the narrative. You have to basically then kind of backtrack what they have then provided. So usually at that point, in those situations, what we do is we ask the seller to contact the buyer and say, "Hey, I went out, I've sought professional counsel. I'm now working with an M&A advisor who's going to represent me in this. Please begin to kind of communicate with them, and they'll communicate back to me, and then basically it's kind of a handoff in that communication. We'll then collect whatever's been provided, and then we'll take that. Hopefully it's not too much that they've shared, but typically whatever level it is, we'll work with the seller to then kind of create a normalized set of financials, get to a normalized level of EBITDA, and then we'll start to proactively put together all of those additional schedules and things that a buyer is going to ask for. If it's the other way, and there's been nothing shared, and this is like a pure go to market, we're going to run a competitive process. We start again. This is one of the main reasons we start with evaluation, because as part of that valuation is we're putting together a financial workbook. Everything that we ingest is typically coming from raw data from our client, whether it's QuickBooks data, data from their accountants, whatever it is, tax returns. We will ingest that data, normalize it, and then we use that as kind of the source of truth across all of the different forms of communication. So whether it's a teaser, a sim, everything has to have a source of truth to tie back to. And when you can do that, then you create consistency across all the different marketing materials and financial workbooks, et cetera, that are being shared with buyers. And you know exactly the questions that a buyer is asking. Because I don't think there's anything scarier than a buyer reaching out and saying, hey, can you explain, this 12% margin in, whatever to me? And we're sitting there like, what 12% margin? And then you realize that they got shared something that we didn't provide them. Um, so it's a lot of, creating a source of truth, consolidating everything into one nice financial workbook, and then using that to overlay into all of the other materials that you're going to share with a buyer. And the other thing that does nicely for a seller is it allows you to start organizing a data room. which is, where you're going to house all of your financial documents, your tax returns, employee agreements, all of these things that eventually a buyer is going to ask for once you get kind of post LOI and into due diligence. And then again, it's another step of consistency. It's like, hey, yes, all of this underlying data and all this additional detail confirms the financials and everything else that have been shared with us. So, long-winded way of saying it's about a source of truth, and then having that source of truth be what gets added into everything else that you supply a buyer.
I love that. So it's sort of it's the business Bible. It's the one truth is,
Yep.
what you originally compile and then what you kind of speak to. So I love that.
Yep.
Yeah. As folks are still hanging with us, if you have seen businesses with messy financials, go ahead and put a two in the chat. Just making sure that Ryan and I haven't put you to sleep yet, and keep continuing to add those questions in. I saw a couple get thrown in. We'll try to get to those, you know, near the end of it. So if we keep moving, you're being valued before you're being modeled. What are some seller takeaways?
Yeah, I think this is really just a way of kind of wrapping up all of the things that we have talked, about to this point. It's how a buyer in those first 20 minutes, it's really their job, especially, as a sophisticated buyer, or maybe they're part of a PE firm or a strategic or a searcher or family office. Their job is to go out and make good investments. They can't spend, as much time as most sellers would probably like trying to understand their business. So the first thing that they're going to instinctively do when they go into these conversations is begin to price risk, before they look at any upside, because upside is always, in the future. It's based on. And what they want to understand is your business today, where it's been, how you got to where you are today, and help me understand what risk I need to price in as I begin looking or assessing this deal. And if we've done our jobs as, you as a QofE professional and an M&A advisor, us, through valuations and being M&A advisors, if we've done our job, we can mitigate that, um, to the best of our abilities and give you the best chance of maximizing value at the end of the day. But understand that, while a buyer's questions initially may seem very straightforward and innocent, it's just human nature to look for the risk. We are naturally risk adverse people. And as awesome as a lot of these businesses that we represent are, if you look hard enough, you can find risk anywhere and everywhere. It's about the clarity and the positioning and how do you present that business such that a buyer is not going to see all of that risk immediately. And it allows you to get further in conversations. It allows you to get deeper, down the road, and really expand on and confirm a lot of the value propositions that you're trying to sell in that initial 20 minutes of a conversation. Um, Again, I don't know if I can say the word clarity enough, because anytime you get a buyer to scratch his head, that's immediate risk signal, right? And they might not be, physically scratching their head, but you can see like maybe there's a pause, maybe there's a shift in body language or facial expression, or they're re-asking a question that they've already asked. Um, it just avoids a lot of that, because as soon as they start going down that, ooh, that seems a little inconsistent or unclear, you're introducing the potential for risk. It doesn't mean that they've already discounted you, as I'm sure you know, but it creates a question. It's like, any audit you've ever gone through or QofE exercise. It's like if you find something, usually you start tugging on that string a little bit and you start unraveling a few more things, right? The best thing you can do is just provide that clarity, that transparency, that doesn't allow them to start pulling on some strings if it's not, especially if it's not necessary to, right? Um, so just being well prepared, for those conversations, um, and just being very professional in it. And again, I know it's hard because these are very emotional conversations, especially, if the reason why you're selling may be emotional. Sometimes this comes from, life events that happen. and you're kind of forced to sell your company. So maintaining, a level of professionalism, being strong in your narratives, knowing your numbers, and really just controlling as the seller that first 20 minutes. From a point of, credibility, defensibility, and just being clear and transparent, it is just super important, and it really sets the tone for the entire relationship that you're likely to have with that buyer. And if it's a buyer you go, the long haul with, as you know, it's a long relationship.
Yeah, absolutely. And there's so many good nuggets. I always say deal making, there's so many emotions that go into it. There's a lot of times where sellers are running a, almost a perfect process, and they get hung up on one component of the deal, or maybe they get offended by one line of questioning, and the entire process just unravels.
Yeah.
Unfortunately, this can be the buyer's fault, but ultimately the seller, you know, their exit plan, or that retirement needs to make it to closing. So it's kind of important to stay level-headed, and this is why you pay top dollar for these advisors who can step in, like the folks over at ExitWise, um, to coach you through this process, to have those calls, to kind of talk you off the ledge, because these multi-month exercises can be, they can be daunting. So I certainly understand it. So many other good nuggets. Um, as we kind of hit the closing, we could probably go on for hours about this. But what's the $1 million first impression owner should do? So, what do you say to an owner if you're talking to them, trying to convince them to represent them? Like, what's that first impression?
Yeah, again, it goes back, I think, to probably the same three C's that I think we've said multiple times. It's clarity, consistency, and control, right? Are you clear in the value proposition of your company, what you do, who you do it for, who your customers are, what your high level numbers are, and can you convey that with extreme clarity? And then consistency, we touched on it, right? If your website is saying something a little bit different than your teaser, which is saying something a little bit different than maybe some high level financials, which is saying something different from what you're actually saying to a buyer in those first 20 minutes. Um, it, it goes a long way to have consistency across all communication channels that you're going to have with a buyer, and understanding what they may have just free access to outside of anything that you've personally have provided to them. And then the just controlling the conversation in terms of just from a way that says, I'm professional, I know my numbers, I know what I'm talking about, I know why this company is valuable, I know where this company can go, I know what you the buyer, I know what your thesis is for this investment, and I'm speaking clearly in consistency to that. Um, and then, I don't think that anything gives you better control in those conversations than a pre-go-to-market QofE. And this is not, to just keep plugging, the O'Connell Advisory Group as a QofE expert, but I I literally tell every client we speak to who's about to go to market, I try to talk every one of them into a Q of E. And that's not something that ExitWise provides. That's not something we're making money on. We are simply, we have people like you at O'Connell Advisory Group who provide those services. But the value from that is just, it's incredible how prepared, how much clarity that brings, how much control it brings. And the one thing I think that if I could leave any seller with anything coming out of this conversation, it's that having seen enough deals, having been doing this long enough, every single seller will have to some degree a skeleton in their closet, and that skeleton may not be as bad as you think it is, right? Buyers, I think what sellers need to understand is that buyers have seen almost everything. There's almost nothing that a buyer can't price in. It doesn't mean that, you have skeletons in the closet, let's keep them there, let's hide them and hope they're never discovered. It's the Q of E is about bringing them out, creating a narrative around them, and then fixing them, or being able to explain them as you go through that process. Because it doesn't matter if you do it now yourself and play offense. If you don't do it now, The buyer's team is going to do that later, and then you're going to be playing defense. Again, long-winded, but control is just super important. Knowing all the ins and outs of your businesses, not hiding from the skeletons doesn't mean you introduce them in the first 20 minutes, but doing that QofE is very, very critical in my mind to a successful outcome. You got to understand as a seller, most transactions fail, and they fail for a variety of reasons. Um, and you can get ahead of almost all of those reasons by doing a QofE ahead of time, and making sure that your house is basically in order before you go down that M&A road.
Yeah, and you know, I certainly echo the thoughts around doing a sell side QofE. I can also I understand the dollars and cents about the cost of these things, and I don't take it lightly. It really speaks to the fact of what is your end goal. If you're serious about selling a business, these skeletons or potential deal points can either be negotiated upfront or they can be negotiated at the end. And when they're negotiated at the end, it can lead to a broken process, which no one wants to waste months on end of time, money, where you could be running your business, which is supporting your livelihood, for a broken process. The second point is when these deal points reveal themselves in the last 30 days, you've lost leverage. You're playing defense, not offense, and a lot of times good buy sides can take advantage of that, and they can start to muddy the waters, for better or for worse. This is what buyers will do. They will start to muddy the waters about why your business is flawed, why they should pay less, how they should receive the money, why you should pay more working capital up front because of these flaws. They'll take one perhaps minor skeleton and make it a big deal. These are multi-million dollar transactions, and as the larger the business, the more sophisticated buyers will, use these tactics against you. Um,
Yeah. Yeah, it's
when
super important to your point to know that there is so much deal fatigue at the end. There is everyone's running on fumes, emotions are at all-time highs, and you're on defense. You've got sunken cost fallacies at that point. You're really just trying to get a deal done. But yeah, it's incredibly helpful to be more offensive and doing that up front than to your point, doing that all in the back end and playing defense when you're already like the honeymoon has worn off and you were just sitting there. You thought the goal line was 4 weeks ago, 3 weeks ago, and you're still dragging this thing on because there was a skeleton that's probably, to your point, maybe it was just a yellow flag. It's not even a red flag or a deal killer, but it's just something that just wasn't disclosed early enough of the process.
Yeah, and unfortunately, some of these buyers, especially if you're being solicited by a private equity client, etc., um, these are marathon runners who do this every day for a living, so they don't get fatigued. They don't get as fatigued as some of these first-time sellers. So it's almost if you're running a marathon against Olympians for the first time. Like that, you may feel tired when they are just kind of getting warmed up and started, and whether it's the right or wrong way to do deals, this is what I see in practice. So for some of those sellers and owners who are still on this call, you know, the deal fatigue is real. So the sooner you can address those things and get aligned in your own house, kind of the better, in my opinion. So I think it's a good point to kind of put a pin in it. Here is, Ryan and I's contact information and QR codes if you do want to connect with us. With that, I will go ahead and pause if there's any questions that kind of trickled in. Um, but yeah, I really appreciate the time, Ryan.
Yeah, thank you so much for having me. Hopefully this was helpful. To anybody listening in or anybody who may listen, at a later date. And Patrick, thank you so much for having me. This has been great.
Yeah, it's been an absolute pleasure. We had one question come in regarding, you know, the need for financial normalization, et cetera. and it's important to make a clarification about the types of businesses we're talking about. So, Ryan and I work with a lot of largely unaudited companies. So these companies are not audited. So really the only source of truth that they're required to show is, a tax return. As we know, tax returns can be manipulated to minimize taxes, which is very different than showing the business earnings. So we talk about privately held small businesses. That's what this kind of dialogue was about. So a lot of times, an M&A firm like ExitWise needs to come in and normalize these financials, or leverage a QofE provider like my team to produce a sell side report to show a normalized earnings. So I think that's an important stipulation. Ryan, anything to add there about the differences between like private and audited companies?
Yeah, no, I think you hit it right on the head. There's typically, again, going back to that source of truth, it's going to be a tax return, and that's for the buyer, right? As the seller, you're going to think, well, I have my QuickBooks financials, and then you get the tax returns, and they don't even come close to matching. You hope revenue is at least very close, but a lot of times, to your point, you're throwing everything in the kitchen sink that you ran through your personal credit card or your company credit card or your company checking, and you're using those as deductions, or your personal vehicles, but maybe those things aren't pertinent to the business. So if I'm a buyer and I'm coming in and I'm buying this business, I need to know, what are my ongoing expenses? What do I need to pay operationally? What are my CapEx needs? And the tax return in this market, phase of the market, doesn't always do a good job of accurately depicting the true profitability of a business, because again, your goal in a tax return, like Patrick said, is to minimize tax liability. And there's always some, fun and games being played there. So the one piece of advice, if you are in that bucket where, your QuickBooks financials probably don't match maybe your tax returns, or other, I would, as long as you keep a very well documented bridge that creates, at a line level detail, all of the different transactions each year that you're using for your personal, or for your business tax return, versus, what you might have in your QuickBooks or other set of financials. Understanding the bridge can help bring buyers a lot of clarity and comfort around, what am I actually paying for? What are my true ongoing costs? And are we hiding cost, right, in the financials? Because your tax return seems to have, a $500,000 more in expenses than what your financials that you gave me have. Help me understand what those or expenses are. And as long as you can explain and talk through them in a detailed way, again, you can usually, get to the finish line where everybody's happy.
Yeah, and I agree with all your points. And this is something that comes up a lot when there is pushback about tax returns not matching up to QuickBooks. And I always like to use the example of, um, you know, filing your taxes accurately is discretionary. Whether, taking it, whether forgetting whether it's, the legality side of it, you can file a incomplete or wrong tax return, and unless it's audited, you may get away with it. I'm not advocating for this, certainly not. But just because there are differences in the tax return compared to QuickBooks, your job as a buyer is to understand, what is the profitability of this company. Putting the tax return aside, what does this business spit off from a cash flow perspective? Because that is how you create an investment thesis around, is this investment worth it for X business? So I think it's kind of important. I coach that point a lot, because buyers will turn to me with when there's reconciliation issues, or maybe there isn't even a bridge between the two. And really the source of truth is, in a perfect world, there is clarity, but at the end of the day, the tax return is not required to be accurate. It should be, but it's not.
Right.
It
Yeah.
doesn't have to be. Um, Got another one. Ryan, I'll pass this over to you. This is for any insights on how female buyers can establish strong relationships with sellers from the start. So it kind of speaks to that 20 minutes. Um, you know, a strong buyer website, SBA letters of support, proof of funds. What would you say to this person on how to establish a strong relationship with some sellers?
Yeah, I think if you're the seller and you're looking to build a credible relationship, I don't think any of the things that we've talked about don't apply, to the buyer as well as you're trying to create those relationships. I think the clarity, transparency, all of that is just as important to a seller. I can say that the one thing that seems to matter most to the sellers that we represent, and we start every conversation this way when we first have those initial meetings between buyer and seller, is we have the buyer introduce themselves, and then we have them explain why they're interested in this deal, and you hope that they've listened to the things that we've told them in terms of what the seller's intentions are, what they're looking for. A seller may be very sensitive to their legacy, to retaining employees that they've had. They may be susceptible to different emotional drivers, and typically, you're not giving away all of those specifics, but you're telling the buyer ahead of time kind of what matters to the seller. And so just showing that, as a buyer, that if those things appear at any point important to the seller, that you hear them, that you understand where they're coming from, and that your thesis for buying them fits exactly what they're looking for from a transition perspective. And then just being transparent about your investment criteria. One, obviously proof of funds and things like that, that goes actually a long ways in proving that you're a serious buyer at least, and that you can actually pull this deal off at the value that maybe you've indicated. What is the target size range of a company that you're looking for? What is kind of your upper and lower bound? And I know maybe you don't want to give all that away, but a soft range or something. You don't want to say like I'm willing to pay X and get it in the seller's mind that they might receive X. But just being, having some transparency around that, or maybe just a deal structure, explaining what kind of, structure you're looking for in a business. And then the other big thing is being very upfront about specific red lines that you have. Like if your churn is blank, I can't invest in that. If your margins are below blank, if you don't meet the rule of 40, and for those listening who aren't sure about the rule of 40, right? If your growth rate plus your EBITDA margin, those two percentages don't add up to equal to or greater than 40, a lot of buyers use that as kind of like a rule of thumb, like I'm not interested in anything that doesn't meet rule of 40. Or if you have, if 75% of your revenue comes from three customers, like not interested. There's too much risk in that for me. So defining, what those red lines are super helpful. And it just signals to a seller that you know exactly what you want, you know what you're looking for. You have the backing to take this deal to the finish line, and that you care about their perspective in the deal.
Yeah, a lot of great points. There's another post about the rule of 40 that I may steal because I love that analogy, and buyers will talk about that a lot. Let me ask you this. This is a question that comes up a lot with buyers I represent that often lose out on a very competitive LOI. So you seeing in the lens of the seller, how do you deal with that? For example, let's say there's two buyers or three buyers. They've all offered the same price. How do you coach them, or what do you do in that situation for sellers on how to pick the one?
Yeah, typically, again, we've had conversations with them ahead of time on their preferred structure. So, if we're also assuming that, the enterprise value is the same across the board, the offer are the same, maybe cash up front is the same, the structure is the same, they're almost always going to go with the one that they had the best emotional connection with, like almost always, because they're going to go with the one that they believe in the most to take this business to where they envisioned it could have gone had they stayed on and ran it themselves. There's a lot of emotions that drive decisions for better or worse, at this level of the market from these sellers, because it's the usually the only time that they're going to sell a company, right? There's a lot of, one and done sellers, which is an extremely fortunate position to be in, right? It's not to be taken lightly, and they put a lot of their heart and soul into it, just like they have done for the last number of X years building the thing. They want to know that the person who's taking it from them typically is going to take care of it the way that they would have had they stayed and kept going with the business themselves.
Yeah. Are you ever, I'm sure sellers have asked situations where they're, indecisive or asking exit wise for advice. Are you focused on certainty of close, the buyer profile, like anything top of mind?
Yeah, I think it goes back to at that stage where you have received that, like a lot of times they'll want to know that the buyer is credible, that they can actually close on that deal. They have the funds available, so some sort of proof of funds or backing proof that they can pay what they've offered in their letter. Um, Another big one is time to close. So if somebody has detailed a time to close in there that is much more preferable to them based on, when they need to close by, as you've seen, I'm sure you've seen this, a lot. There is sometimes a time crunch and when a seller needs to sell by for a variety of reasons. And if they have a buyer who appears through conversation and through the structure of their LOI, the detail of the LOI, the content of the LOI, that this buyer is going to get the deal done quicker because they're more experienced, then they'll probably be more apt to go with that if their concern is strictly time based. Regardless of if they think that this person's going to take better or worse care than any of the competing offers of their business, maybe they only care about speed to close. Um, Maybe they have better defined or more loosely defined terms, right? In there, maybe networking capital requirements are a little bit more favorable in one, versus another, or not as well defined, or defined more in the seller's favor. So it usually comes down to a lot of the details, but ultimately it comes down to what is the buyer or what is the seller's motivation for selling, and which one of those offers, all else being equal, will, in their mind, be accomplished based on the goals and objectives that they have.
Yeah, great points. And it's tricky because it sounds like there's not one clear answer to the test. For buyers kind of going through the agony of being rejected in a competitive process, I've worked with a few folks who have been looking, either independent sponsors looking for these businesses, and they've gotten very close on a few opportunities only to lose out on a very competitive bid process. Um, and it's tricky. I think a lot of it is being liked by the sellers. If you have certainty of closing um, and present favorable terms, I think it's just building rapport. A lot of times, if all else is equal, a lot of times it's not all equal, but things like LOIs being, bullet points and not narratives about how great the buyer team is or what kind of experience. I've heard that from some sellers. Those are some
Yep.
things I see in practice.
Yeah, it's always such a tough game, and we on our side, like it's you always feel bad sending those emails out where you have to eliminate somebody from the process, especially when they really cared about the deal, they put their best offer forward, they came up and really listened, but at the end of the day, it's you got to choose one, and it's always a bit of a heartbreak to kind of turn them down. So understanding what you can do to get a little bit of an edge is always helpful. But ultimately, it comes down to really understanding what does the seller want, what are their emotional drivers, kind of playing into like the psychology of it a little bit. Not that you can be a bad actor, but such that you can, make sure that you're being understood in the same way that you feel you're expressing yourself.
Yeah, I agree. There's definitely an art to this, and the more reps and kind of LOIs you send out, you get a little bit better at it. So I tend to agree. I'm going to answer one more, and then we probably will go ahead and close. This is for me from a DD perspective, what key questions can we ask from the onset to understand if their systems, financials are ready for the process? For example, when will you have 2025 tax return ready? Can you readily pull X, Y, or Z? I appreciate the question. So to keep it simple, and Ryan, I'd love to hear your thoughts. I'll often ask questions about the financials if they have monthly financials, maybe some tax returns, etc. If they have bank statements willing to share. To answer this question clearly, a lot of these questions and data requests you won't get access to until you have that LOI because the company, rightfully so, wants to keep protective information close to their chest. Um, Ryan, what would you say to this person? What are some questions that are appropriate early in the stage to ask these sellers that you represent?
Yeah, I would say that we don't have any issue with telling with a high level of certainty telling buyers at this point that this information is readily available and will be shared post LOI, to your point. I don't think excuse me, a lot of these things are very sensitive to sellers. Nobody wants to share, bank statements and customer contracts, and maybe like IP, tech stacks and things like that early on because they don't know at the end of the day if the person they're talking to is representing a competitor, is a bad actor, etc. Again, we do as much of the work as we can filtering those types of buyers out and really only putting buyers in front of sellers who are credible, they meet the criteria. They've done this before, maybe they're first time buyers, but we've vetted them a little bit. But to your point, a lot of those things they really don't come, for the protection of the seller and until you're further down the line. But we do like to make buyers comfortable around what is readily available. Not just because it gives you a sense of comfort around, okay, due diligence should hopefully be easier or a little bit quicker. But one, we've already started to collect a lot of this from the clients ourselves. So we have them ready to share. But again, it's part of that preparedness that the seller should have. It's part of the consistency, the source of truth, because we don't want to ever mislead a buyer by representing a seller who's a bad actor. We need to do some level of diligence ourselves on a seller and make sure that they're credible, their business is real, their numbers are real before we put them in front of a buyer.
Yeah, and I agree with all those points. One thing I'd say to the person who submitted this question is understand who is representing the sellers. If they're being represented, not to plug exit wise by an M&A firm, they likely are ready for the process because any good M&A firm, not a individual business broker, has their name and reputation on the line for these sellers. So if they represent sellers and they're not ready for the process, word travels quickly, especially in the SMB space.
Yep.
Um, and it goes the same for some of the buyers I represent. You know, any good buy or seller rep is looking to weed out uh, bad apples because um, our brand names are more valuable than any individual client. Unfortunately, it kind of is what it is. So if you see a company being represented by a very reputable M&A firm, those companies are ready for the process. So I think any good buyer should have full confidence in those listings. So just do a little homework around who the representative is. Um, Maybe ask your network about them if anyone's done deals with them. And you can pretty quickly get a sense for, hey, is this representative just trying to take on as many business listings as possible, or are they really being thoughtful and conducting this process before they go to market? I
Yep.
think those are two stipulations. That's kind of food for thought.
Absolutely.
Um, Very good. Well, I'll go ahead and wrap up. Again, for those of you who didn't get the questions, feel free to reach out to Ryan over at ExitWise or myself on LinkedIn. We are kind of an open book, but yeah, Ryan, thanks again. Really appreciate the time and so many great nuggets from the seller's viewpoint. So really appreciate it. Thanks for
Yeah,
joining.
awesome. Yeah, thank you so much for having me. I love the conversation. Hopefully we can do it again.
Yeah, let's do it again soon. All right. Take
Absolutely.
care, everyone.
Thanks, you too.
All right.